Let's take a look at what the markets are doing because it's another day of a record high coming in for the benchmark indices. You had Nifty as well as Sensex hit record high levels right at the open, and from there on we are actually trading in a range. Talking about the Nifty Bank, that one is outperforming the benchmark indices, 0.5% gain coming in for the Nifty Bank. You also have broader markets that are pretty supportive of the gains coming in today's trading session, with the broader markets actually leading from the front now near the day's highest point. But which side of the markets are headed from here on, and how should you position your portfolio? We have Mr. Abhay Agarwal, who is the founder and fund manager at Piper Serica, joining us on the show. A very good afternoon to you, Mr. Agarwal. Thank you so much for joining us in ET Now. And first question is, given the fact that we're hitting fresh record high now on the markets once again, do you believe that the market valuations is now looking a bit stretched, or do you think that it is not that expensive yet?
Good afternoon. Thank you for having me on the show. I think if you look at by traditional standards, the valuations are definitely on the higher side. I don't think the valuations for the index, and when we look at valuation, we typically talk about the valuation of the Nifty index stocks, the 50 stocks. So if they're not in the exorbitant range yet, they're still at about 20 times FY26 earnings at the index level. So I would call it that this valuation is so far stretched that there are no opportunities. At the same time, would the valuations at a level that you can say with a lot of certainty that anything you buy will make you money? I don't think we are there also. I think we are somewhere between fair value and expensive zone. So investors will have to do a lot more work right now, to make money, in the sense that they can't just look at index stocks, or they can only look at index funds, but they have to become a little more active and look for opportunities that are not part of the index stocks or not part of the flavor of the month stocks to make money. So I think there are still opportunities if we look away from the broad market valuation, but investors will need to work to find those opportunities.
So let's make it easier for our investors and our viewers then. So where do you think the pocket of opportunity lies in the market? Like you said, you need to look away from stocks that are primarily in the index, but look at stocks that can offer value. Which pocket of the market do you think the value lies right now then?
I'll talk about us and what we have been doing at Piper Serica. So our approach is to look for opportunities that are not very popular right now. Some of the segments that have probably disappointed the markets for some time and have gone through a sideways time correction, but get in at a time when that sideways time correction seems to be getting over because the two things have happened. Either the industry has hit a bottom and is now recovering, or the valuations have become more attractive. So three of the sectors that we are fairly bullish on now are number one is insurance, and that includes both life insurance, private players in life insurance, health insurance, and general insurance. So not a buy recommendation, but since our model portfolio is pretty well known, so we have three names in our portfolio that are part of this group. One is ICICI Lombard, ICICI Pru, and Star Health. These stocks have already done well for us, but I think looking at the long-term opportunity that India presents for insurance players, there is a long way to go. The second space that we have been fairly active in and have placed our bets already is agrochemical space. Again, a sector that has disappointed the markets because of flattish earnings for a very long period of time, a lot of pressure from China, dumping, poor pricing, no pricing power. But that seems to be changing now slowly, but it is changing as the dumping from China has reduced and some of these companies are seeing some pricing power come back. And the third sector, again, that we are fairly bullish now is the pharmaceutical space. We have been investing in it since the beginning of the year in the large caps, and we are seeing some good returns already. I think investors get too focused on the short-term valuations in the pharma stocks, but if investors look beyond FY26 earnings, then they will find that these large cap pharma stocks in India like Divi's and Dr. Reddy's offer tremendous opportunity for long-term value creation. So I think these are the three sectors where we are seeing attractive opportunities right now.
Right, but what's even interesting is the fact, Mr. Agarwal, when I look at the sectors that you are not too positive on, and that would be banks, NBFCs, and IT. What was the rationale for that? And also, I will dig in deeper for IT sector because for the last few trading sessions, we've seen a good up move in IT sector. People are of the view that now that you may have a rate cut cycle starting at the United States, or hoping that it actually takes place, the scenario for BFSI segment would look better in the United States, will aid the IT sector. So what's your take, one, on the banking space? Why is that in the underweight stance for you?
Yeah, I would say it is a bit of a brave call for us, but it is coming from the data that we are seeing at the grassroots level. We are seeing three things happen for the lenders. I would club that segment as lenders, which includes large banks, small regional banks, and NBFCs. We are seeing three things happen. One is that the cost of deposits is going up. So first of all, it is difficult to get deposits even for large banks with large branch presence that used to drive deposits. They are not as easy to come by. So what is happening is that the cost of capital is going up for these banks. The second thing that is happening is that there is an increase in cost to income ratio, and that is driven by higher rents, higher operating costs, higher salaries. And the third thing is that there is a deterioration in asset quality, especially in the unsecured loan books. If you look at loan books, some of these credit card players and personal loan providers, plus also microfinance companies, there is a clear deterioration in the asset quality. It is not alarming yet, but the trend is not good. Now, some of it is being explained as a seasonal phenomena because of the elections and heat wave in the last quarter. But we believe that it is far more sticky. You know, there is stress at the grassroots level as far as repayments is concerned, as far as ability to pay on time is concerned. And we would like to see the collection efficiency especially improve over the next couple of quarters to build a more positive view. But with these three things happening, it is creating a bit of a vicious cycle for lenders right now. And in an environment where Indian banks and Indian NBFCs already trade at probably the highest book value multiples in the whole world, I think investors will soon ask the question that if these banks are going to grow now in a single digit, then are those valuations justified? I think we have a very positive long-term perspective on this segment because it is very critical for GDP growth. But in the short term, we are being very cautious. We want to see the metrics improve before we get back into this segment.
Right. The IT sector actually is something that we've been watching out for very closely, isn't it? Like we've been talking about it. What sort of indication are you getting with these IT companies? You don't seem to be enthused at all.
Yeah, I think again a very large sector, and it is a very valuable sector of the Indian economy that has created jobs, that has driven the economy for a long period of time. I think this is a segment now which is getting into consolidation phase, and I think some of these guys may benefit from the short-term boost that may come in. I mean, that is also I don't believe that simple logic that just because of rate cuts, banks will suddenly start spending on open up their IT budgets. You have to look at US banks. They are under tremendous margin pressure. They are being told to cut costs. And a lot of the work structurally is moving towards AI and generative AI, where cost of doing a project for large IT companies should come down, but it is not coming down. So I'm a little worried right now that the Indian IT industry, and this is their own guidance, it's not something that we are deducing, but even if we go by the guidance that large Indian IT companies have given, they are talking about a 0 to 3% top line growth at best over the next year. Now, with that kind of growth, I don't see why should we as investors be willing to pay a 25 to 30 times forward P multiple for a company where the management itself is guiding for a very flat growth, no growth, or minimal growth. So that is my problem. That these stocks may seem defensive, they may seem value stocks, but as fund managers, if we buy them, we may just go without making any return on them for a year or so. So again, I would like to see some positive triggers develop here. I would like to see the management commentary improve when they talk about quarterly results to make a bet again on these stocks.
Very rightly put and aptly put, actually, why you are not in favor of the IT sector right now. And also, very nicely you summed up what's exactly happening in the banking space and why we all have taken the brave call to actually be underweight on the space right now. But we'll leave it there, Mr. Agarwal. Thank you so much for joining us on ET Now to talk about the market scenario, the sectors that you are favoring, and also why you are currently underweight on banks, NBFCs, as well as the IT space.
If you like this video, then like, share and subscribe to ET Now.